meantime, let's get in some technical trades going as well. And Naresh, let's find out what your outlook is on some of the individual buzzers then on Friday's trading session. Within the broader market, some names that did manage to stand out include a Piramal Enterprises, and you also had a KPIT Tech that was a buzz. What are the charts indicating here?
So Piramal Enterprises is interesting. If you look at the price action for the last few months, every time the stock has gone to 780 to 810 levels, it has bounced back. It has made almost say 5 to 6 bottoms around that area. In the interim, the tops are placed around 920, 930. It came very close to it yesterday on Friday. So if it can sustain about 920, that would be a major trend change for the stock. And yesterday was a very large volume day, so that is more interesting. So the volumes in the last two sessions, one post the numbers where we saw an intraday recovery in the stock, and yesterday was almost 5x the general volumes. So out here, in case of a dip closer to 870, 880 is where one should be looking out for a buy in the day with a stop loss at 860, and then watch out for 920 if it crosses. Maybe add more positions after that.
The report from Morgan Stanley on PB Fintech, and what they are making a case that PB Fintech is a buy. Price target has been upgraded to 705. Currently, it is at 525. Some of these stocks in January end or middle of January when anchor investors was selling out, they just got smoked. Paytm slipped below 500. PB Fintech almost went to 320, 330. Zomato came almost to 44, 45. So some of these stocks, when the anchor pressure was there, I think they simply lost its bottom, so to speak. But I'm going to go back to one Adani group of stock, Sandeep, which perhaps which deserves some discussion. Ambuja. Now, Ambuja is not an original Adani group of stock. It is a company which Adani Group acquired last year. It's a company which has a predictable track record. It's a sector where you know that the demand, at least for next couple of years, is going to be strong and static. It's a company which the balance sheet of Ambuja and ACC is also not very leveraged. Why do you think Ambuja and ACC are underperforming? At 365, if one is looking at buying into Ambuja or at the current juncture of ACC, are these stocks a good contra buy? Do you think they're suffering because of technical overhang, not because of a business cycle downgrade?
Yeah. So your last sentence actually sums it up, because it's more technical overhang, because there is fear in the minds of the market participants that what if some pledges come in to sell and there's post selling, etc. So I think that always comes up when the entire group comes under question. On the other hand, as far as pure fundamentals go, I think they are reasonably well placed. Cement sector overall, I'm not so gung ho, because volume growth will be there, but supply increase is very, very strong next 2-3 years. So I don't think these companies will have much of pricing power. But given that Ambuja fell from 600 odd, I think at the peak, to 320, 330, so we also picked up something around those levels. But I'm not looking at very huge targets. I think it will be more like something like a swing kind of investment.
Viresh, Ambuja, I think, is an F&O ban. Can you deconstruct what it means for our viewers? And if a stock is an F&O ban, should one be trading in it at all? Naresh?
So, say once you're in F&O ban, when the market-wide position limit crosses 95%, it has to go back below the 80% to get out of ban, and comes out the next day. But as per the new rules post-COVID, you cannot roll over positions in ban anymore, and that creates a problem. So once you've created a position in such an, even before ban, you have a problem around the rollover time. So one has to be careful trading in these names on the derivative side. And once you're in the derivative ban, you cannot buy futures on that day once you're in the ban period. So you can only trade it via the equity segment. So in this case, it becomes a case where stocks get more volatile in a tight range, and every time it keeps coming in and out of the band, there are gap ups and gap downs. So the best way to trade them is to actually look at it from an equity position. So you cannot short it unless it is in when it is in the ban period. So simply put, one can be looking at a little longer term view and looking at it as equity segment trade. On the derivative side, one will have to contend with the volatility, which will continue till the time this situation continues. And Ambuja Cements earlier would not go into the ban as much. It is only post the Adani fiasco wherein it has started going into the derivative band. So at my current personal view on the stock is at 330 to 360, the bottom is done, and that is a good zone to accumulate for the medium term.
I want to look at Tata Motors. Why? Because there seems to be a mild outperformance which now suddenly is visible. I'm talking about the technical aspect here. Second, globally the JLR supply constraints, which is the chip shortage, now seems to be getting addressed. And when it comes to EV, the Economic Times couple of weeks ago, I think Arijit, my colleague from the Economic Times, did a story that Tata Motors looking at getting another round of capital infusion from new round of investors in their EV business, and that could be at a premium to the last deal, which I think was 15, which happened I think same time last year. Bottom line here is that Tata Motors is doing whatever it takes to address the debt they have. Sandeep, we spoke about Tata Motors that incrementally you've added into Tata Motors. If you have to choose between Mahindra and Mahindra, which has been a core holding of yours, which has worked like a charm, and I'm sure our viewers have benefited because of that call of yours. If one has to choose now between Mahindra and Tata Motors, which way would you lean and why?
If you have to choose, then from a percentage gain perspective, the possibility that Tata Motors will give more gains is greater. Simply because of the fact that as a turnaround happens, the operating leverage tends to play out. So, from a company which is already doing well to a company which starts to do well, the operating leverage in the one which starts to do well is much greater. And to that extent, earning surprises can be much bigger in Tata Motors than in Mahindra and Mahindra. So, from a pure return perspective, Tata Motors should be able to do better.
What about your outlook, Sandeep, when it comes to the entire defense space, owing to the fact that maybe it was a bit of a disappointment in terms of the budgetary allocation to the defense space, but there have been a lot of other very proactive steps taken by the government through the rest of the year. So your take on some favorites within this pocket?
So what's happened on the defense side is that the stocks ran up rapidly, and in the expectation that the delivery of results will be very, very strong. And then as the results came out, people have seen that the pickup always tends to be slower. So the order books get translated into actual execution over periods of 3, 5, 7 years. And to that extent, some earnings have been below expectations, be it from Bharat Electronics or a HAL, etc. So I think that builds in a case for consolidation at this stage rather than strong buying in many of them. And eventually, as we get more moderate levels, or maybe the government will also come out with FPOs, etc., which we don't know, we'll see till March. So I think right now it's a time to just wait and watch and look for opportunities to buy into them.
Okay, and I'm just going back to Tata Motors again because what really caught my attention was Chandra's interview. In Chandra, the chairman of Tata Sons, his interaction with the Economic Times, where he is really making a comment on the debt of Tata Motors. Tata Motors as an entity will be debt free by March 2024. Guys, we're talking about net debt here, not total debt. And JLR may need additional few to do so. So roughly 6,000 crore that goes into interest repayment will now generate flows for business, and money from Tata Automotive System is something a company which they're planning to take public will also be beneficial. So bottom line for me is that Tata Motors, according to, it's a forward guidance if you frankly ask me from Chandra, that it will be debt free by FY24. So they are not changing the original plan what they shared with the market before the COVID on when Tata Motors will become net debt free. But in order to reach there, a lot of things have to fall into place. Debt has to come down, JLR demand has to revive, semiconductor shortage needs to be taken care of, margins have to improve, the EV business has to pick up, and the deleveraging what they are planning by a stake sale or by taking a company public, that really needs to be work in progress. So for me, Tata Motors now could be an interesting stock, but it is still work in progress, so to speak. Sandeep, since there is a mention about Indian hotels and the profitability, what they've reported for the quarter gone by, we've discussed this one several times with you. Are you still holding on to your positions?
Yeah, because the performance has been so exceptional that it's taken out all analyst expectations. They have already delivered some, I think, 700 crores of profits in the first 9 months. If you go back to March, April of last year, analysts for this full year were projecting 400, 450 crores of profits. I think the entire hotel industry is in extraordinary sweet spot, which will last at least 2 to 3 years, if not longer, given the demand scenario as well as supply constraints. So I think they are well positioned. So there is no reason to exit your winners at this stage.
Okay, that's the view coming in. Meantime, Rudra, let's get in your take as to what you've made of the movement that we've seen in some of the auto stocks. For instance, you also have M&M that's in the spotlight. Brokerage is pretty upbeat, largely on the back of a steady set of numbers. How are you looking at M&M in particular, and are there any other top bets?
See, for me, M&M on chart has given this breakout above levels of 1,360, 365 zone, and it is consolidating now there. Stock definitely looks very, very strong on chart, and it is a good risk reward to enter at current level. So keeping a stop loss somewhere closer to 1,300, I will take a positional long at current market price or any dips to 1,330, 340 zone, and look at targets closer to 1,500 initially, and eventually it can further move up from there. But however, for me from autos, the top bet would be definitely on Tata Motor. In fact, I even recommended that today. And if you see the F&O positioning in Tata Motor, post the result, that gap up move which came in Tata Motor has been held and it is consolidating now for a long time. This is a clear pattern for me on chart that yes, there is a big move coming up. I won't be surprised to say Tata Motors will be the stock of the year. And for me, risk reward is very favorable. As a trader, for me, this stock has strong accumulation and long-term support zones at around 380 to 400. Current market price is a good level to buy. And once it crosses that range of 485, 490, stock can make a move towards 650 to 700 zone. So technically looks very strong on chart. I will be putting Tata Motors ahead of M&M, even though M&M stock patterns are also good. So, but for me, Tata Motors will be the standout stock for the year. Look at targets of 650 to 700. Keep a stop loss of 380. Buy at current market price or any dips to levels of 430. And this will give a big move for this year.
Right. Okay, Sandeep, before we let you go, let's have some mid or small cap idea that you think our viewers could buy right now.
Sudden question. So,
Yes.
But easy question hai bhai. Easy question hai.
No,
Just ideas.
small and mid caps are tougher because then people buy and then the monitoring becomes tough. So
We'll monitor for you. We'll ask you each time you come whether you still hold or is it a turn to a buy, because you know the large cap list is we've discussed that time and again. So any mid or larger mid cap that you're still recommending?
yeah, I think one stock where I bought initially something and then we have increased our allocations lately is a company called Mayur Uniquoters. So they essentially are into PU, PVC products. So they were big in footwear, then they became big in the artificial leather seat covers for cars, etc. So the stock is at the same level at which it used to be 7, 8 years back because of issues related to profitability, slowdown, etc. post COVID. Now they've got large orders from global MNCs, which will start getting executed from next year onwards. So next 2, 3 years, we'll see very strong growth. And valuation wise, I find it reasonable. So it's moved up lately. So depending, so people can take the call accordingly.
Sandeep, thanks as always for joining in, and thanks for that idea. Mayur Uniquoters is the stock that Sandeep just recommended. But of course, as always, do your own research. Do speak with your financial advisors before taking any call that our experts talk about on the show. But on that note, let's also get some technical ideas from the mid-cap arena going. And Naresh, what's on your list?
So, looking at L&T Finance Holding, which I've been continuing to like, and now the stock is coming on a much larger breakout. So, the stock has made tops around that 96, 98 mark over the last 3 months, almost 3 times. And over the last 2 years, that has been a major resistance. A strong recovery in the near term, where it went back to 85 levels and has recovered back to 95. Structurally setting up for a big breakout, so expecting this breakout to take place in the next few sessions. A stop loss at 88 and a target price of 110.
L&T Finance Holding, interesting bit really would be that if one looks at the Reserve Bank of India's communication, it is evidently clear that if not last policy, definitely post the next policy, rates will not go higher. Which means if you look at going back to the basics, which is that NBFCs, they tend to underperform when interest rates are moving higher. They tend to start outperforming when interest rates are nearing a peak, or when interest rates they start declining. So are we really nearing that turn where NBFCs, which are underperformed banks, they will start outperforming? Banks do well when interest rates are rising. Why? Because they get access to cheap deposit. NBFCs underperform because they are depending on wholesale deposits. Some NBFCs do get retail deposits, but they tend to underperform when interest rates are rising. So are we at that turn where NBFCs now may do rather well if interest rates are peaking out? That's my limited point.
All right, let's find out those top stock recommendations then, and what it is that our chartists are betting on as those pre-open rates have trickled in. 17,859 on the index as we speak. Let's find out what Rudra and Naresh have picked out for the day. And Naresh, your top bets, your mid-cap idea?
So the mid-cap idea continues to be L&T Finance Holding. That looks promising, on verge of a major breakout. It's a 2-year breakout on cards. So L&T Finance Holding could see much more momentum above 98. So a stop loss at 88 and a target price of 110.
Naresh, thanks for once again highlighting your ideas. Rudra, what about your mid-cap strategies?
See, for me, Kirloskar Ferrous looks very, very strong on chart and fundamentally a good company. This stock first gave that breakout at around 275 and it has been clearly moving with patterns of higher low and higher high, and very, very strong chart pattern with accumulation happening now at around 350 zones. So stock has given breakout again at around levels of 370 and making the 20-day moving average as a strong support zone. I will be looking at initial targets on Kirloskar Ferrous at around 450 level, keeping a stop loss of 350. I will buy Kirloskar Ferrous at current market price. Surely a portfolio stock to have. And for the day, I'm picking up ICICI Bank. Again, this stock has seen good accumulation patterns, and F&O open interest addition has been strong on the positive side. So for the day, I will be looking at buying ICICI Bank. 880 one can look at on ICICI Bank, and I'll be keeping a strict stop loss at around 845 for this long call.
All right, there you have it. Those are some recommendations from our chartists. What about the index calls then? Here's what they're advising one should do this Monday morning as we're stepping into trade with a pretty flattish pre-open. It's a buy recommendation from Rudra. Remember, he continues to remain very positive on the index. Hold according to the rest of our experts, and therefore majority wins. That's what the market moodometer indicates on the Nifty index this morning. It's a consensus hold call. Ditto when it comes to the Nifty Bank. CA Rudra sticking his neck out. He believes that it's a buy call on the Nifty Bank index. You just heard out his views on some individual banking names as well. But the rest of our chartists are pretty confident that it's a hold call on the Nifty Bank. That's the view.
Okay, now let's really look at the global setup. The dollar index is just below 104. Crude prices are above 85. They're firmly fixed above 85, especially after what Russia has indicated in terms of what are they planning to do in terms of the demand. Now, bear in mind, the peak of the winter is now nearing its end. So the demand this time was high. We've had a very cold winter, so to speak, but crude prices have not really become, they've gone really out of out of that affordability, out of sync, so to speak. I think Reserve Bank of India on Saturday did indicate that their assumptions are closer to $90 plus, which means that if crude stays below 85, it's going to be, we could brace ourselves for a positive surprise rather than a negative, negative impact. So the global setup, one would say, is okay. But for me, the big hurrah is that on Thursday and Friday, if I add up the FI data, FIs have turned net buyers. And if that trend is here to stay, that for me is going to be very encouraging. Of course, you can argue back and say that on Friday there was a large block deal which happened in Paytm, and the bulk deal is saying that there was Morgan Stanley which was a net buyer. But money is money. It doesn't matter whether it is coming in a fintech stock or it is coming in some large cap stocks. The flow of money ultimately is that the flows were positive. That's one. Second, two stocks which hold the key. If you're an index watcher, Reliance and HDFC Bank. Reliance has underperformed this year massively. And if we are at a real turn, Reliance has to turn. Second, HDFC Bank. It's an heavyweight. I think ICICI Bank has done its trick. Axis hit a lifetime high a few days ago. HDFC Bank is where if the flows really move, then we could be in for a big hurrah moment. So between Reliance and HDFC Bank, or both, they are the ones which really hold the key. It's not a news heavy week. It is not a big week in terms of news. So I will let the clock do all the talking. 10 seconds to go. Nothing large incremental which we can really expect or we should anticipate from the markets, at least this week, barring the CPI data. First rates, Monday morning, we are starting after 2 weeks of hectic news flow. It's a flat start, absolutely flat. Absolutely flat for the Nifty, absolutely flat for the Bank Nifty, absolutely flat for the small and the mid cap indices. You don't see markets like these, but we've been stuck in this range for a long, long time, even for the broader index, so to speak. The breadth is okay, nothing very large. So these are really dull days, and in a dull market, you should never go short. So this is not a market where you want to initiate a short. Now let's look at the green ticks now. HCL Tech, Bajaj Auto, Titan. Some of these stocks are off to a good start. I want to look at PB Infotech, I want to look at Paytm, I want to look at Delivery. PB Fintech, not a great result reaction. Paytm, the steady move continues. And Delivery, where the operating leverage has kicked in, but numbers are not all that great. I think it's down by 10 rupees, but down by 9 rupees. Let's turn and talk about Zomato, and then we'll talk about Lupin, where in a tough time when the drug gets delayed, that's bad news for the near-term earnings watcher. And I will not be surprised, without even looking at the rate, that Lupin is going to be down. There you go, 705 rupees for Lupin. So bad is getting worse for Lupin in terms of the near-term projection and trajectory.
Right, okay. Let's just tell you about some of the other stocks which are also in focus. Nikun just highlighted Lupin, and let's just see what Balrampur Chini as well is up to, because the sugar business EBIT has come in higher by 54%. But white distillery EBIT has actually slipped 88% on year-on-year basis, which is why Balrampur Chini currently lower a little bit in trade. But good numbers from ABB, good numbers from BHEL, Glenmark as well. The earnings have been in line and the profits have come in higher. So have the US revenues managed to match up with the street expectations. Glenmark holding up 1.6% as we speak right now. Lemon Tree, the margins have risen nearly 1,000 basis points. The revenues are higher, 63%, pretty much in line with what we've seen from the ITC Hotel division, or for that matter from an IHCL. But Lemon Tree starts off a little bit tempered in trade. JK Lakshmi Cement, the numbers are in line. The revenues have come in higher, 25%. Rights, wherein they've ordered, or rather bagged an order worth about 65 crore rupees from the railways. So that's another stock which is in focus. Dishman Pharma, AstraZeneca, all good numbers coming in. So let's just bring up Dishman Pharma as well. And the first rates I don't think have trickled in there yet, and AstraZeneca, though it starts off 1.5% lower, but the numbers are looking pretty okay. Nalco also, by the way, the EBITDA has come in much better than expectations, and there's been a margin improvement of nearly about 450 basis points on a sequential basis. Stock is holding up almost 1.6% as we speak right now. Weak numbers from Balkrishna Industries, Info Edge. There's Lupin we've talked about, Coforge as well, which has seen a sizable block deal right now, and it seems that Barings PE is likely to be the seller. in the stake in the company via the block deal which has just taken place, 5.6% lower for Coforge right now. Biocon, US FDA has issued a complete response letter for Mylan's drug. There's City Union Bank, we just chatted with the management. The numbers have been weak there. Metropolis as well, the numbers are below estimates. Margins are down 100 basis points. And then, of course, let's check in on what the Adani Group names as well are up to after the promoter pledging the additional shares to companies out of ASM framework. It's really a mixed bag as it continues to be the case for the Adani Group of names for now. Fortis as well, by the way, the EBITDA has come in lower by 4%. Margins have slipped 200 basis points, although the revenues are up just about 6.5% or so. Fortis currently lower by nearly 3.5%. But let's take it across to Naresh and find out what his take is on the market. Naresh, tempered as always, but any individual stocks that's propping up on your radar and trades that you're executing right now?
So, adding up on Indraprasth Gas Limited, the stock has opened down 1.5%. Stock is on verge of a much bigger breakout, like the whole gas pack. So, Indraprasth Gas looks interesting, and even Mahanagar Gas.
You know, in case you're thinking why IDFC is down, look, there's a special dividend there, and that special dividend, in a sense, is the reason why IDFC stock is down today. So it's not like a absolute cut, so to speak. The cut has to be adjusted in context with what is happening in IDFC Bank and IDFC, largely because of the dividend which is at play. Dinshaw Arani joins us now, CIO with Helios. Let's take our conversation forward. Dinshaw, good morning. Thank you for joining us. We've had 3 weeks of hectic news flow. We are now approaching that lean patch, so to speak. In this patch of hectic news flow, while stocks were volatile, benchmark indices, they exhibited a lot of resilience. Are you delighted and surprised that whatever could go wrong has gone wrong for Indian markets, but yet we are flat for the year?
Nikunj, thank you for having me on your show, and a very good morning to you and your viewers and your team as well. So Nikunj, actually, if you go to see year to date, India is one of the worst performing markets in the world. They may have remained flat, but the fact is that the world has gone away from us. Conversely, last year, India was the best performing market in the world. Okay, so that we are evening out. I think that is what is playing out here. Secondly, you mentioned about China, that you saw the FII flows for the first time on Friday, a heavy flow of 1,000 odd crores on Friday. Our feel has been that that trade of exit India and buy China, I think that is more or less somewhere on the way, on its last legs per se, because I mean, if you go to see the premium that India went to in October end, when China was at a low and India was fairly steady, the premiums are shot up to some 180% on piece, pure piece to China, vis-a-vis China, which on a last 5 years average would have been around 60 odd, and India somewhere there now. So that we believe is playing out to the hilt, and I think another matter of a month or so when this fully plays out. The third thing to keep in mind is that China opened up, right? And actually $18 trillion of savings, rather deposits are lying in Chinese banks, and I'm sure the Fed can see that, and they're worried that even if a fraction hits, you just cannot imagine the kind of upheaval it may cause to commodity prices or to even to the supply chains per se, and I'm sure the Fed is worried about that. Also, the Fed is worried that the employment rates are remaining elevated. They can't see unemployment much, and anyway, the way US is going, I mean, concentrating on manufacturing rather than anything else, onshore manufacturing rather. I don't think the employment rates are going to go down as such. They'll remain at elevated levels. So that's another worry. So frankly, I mean, till the time the world is going through this kind of upheaval, I don't think India will be able to perform as in go up. It may remain steady. In fact, our call is that the next couple of quarters, and we've been calling this out for a while, that the next couple of quarters, we will remain steady as such. And one has seen that, right? I mean, even if the earnings growth, the earnings growth are pretty good. In fact, till the beginning of Feb, when I was keeping track of what was happening, earnings growth was around 18% in the Nifty, the ones which are reported in Nifty. In fact, if you take out commodities and metals and all, the oil and gas and metals rather, the earnings growth was around 28%. So obviously it's been a healthy earnings growth, and despite that, India has been flattish. So the fact is that world has to stabilize before India starts its journey up. However, our feel is that India will outperform in the near term. I mean, whenever it remains flat, because the world will not be doing as much. So that's the call that we've taken.
Right. Dinshu, can't take my eyes off from what an ABB, what a BHEL are reporting. Decadal, high margins from cap goods. Are you scouting any newer stories within this sector? And does it seem like the journey could have just begun on cap goods?
Actually, Aisha, we have been scouting around for a while, but frankly, I mean, our problem is the valuations. I mean, we've been fairly cautious on that front. As such, we may miss out a few names, but as a philosophy is like there are quite a few stocks in the market. If you miss out one, there'll be 100 more that you can dip into. So we're looking at the right prices and the right valuation probably. And frankly, I mean, the way India is going, obviously, when you're talking about capex-driven economic growth, you're talking about really these kind of stocks doing well as such. But ultimately, one has to take a call on how far or what value we can give to these stocks. So we're staying away for the time being.
Can't help but also notice the recovery that one is seeing in the new age fintech companies. I mean, be it Zomato with the turnaround and delivering ahead of the guidance on their numbers, or for that matter, PB Fintech as well, wherein the new business losses have only narrowed. We heard from Zomato as well, and we're yet to hear from Nykaa this week. Change of heart, add positions perhaps at lows?
Oh yes, we did actually. I mean, Samir comes on your channel and gives out the names, which I don't. But the two platform companies that we own, right? And we frankly added once the results came out, and we've been averaging out there as such. And frankly, I mean, both the companies, the results were fantastic. In fact, our feel is that given the potential that India has of the consumer base, in fact, India, if you see the kind of consumers they can appeal to, it's like a whole of Europe put together. That's one single place where these players are working out. And especially in the case of Zomato, I mean, it's a two-player market and they're on the verge of breaking even. In fact, they have revenue on the EBITDA level, but thanks to the hyperlocal, they're still not Blinkit. They still haven't done that. But our feel is that it's a matter of time before they do that too. And Paytm, you saw that. The results were like through the roof.
Right. So with Zomato, are you not worried about growth slowing down? This is one of the companies which has really penetrated major metros. They're going to small towns, but in small towns, Dinshaw, going out and eating out is a celebration. It is not convenience. So isn't there going to be a challenge in terms of the growth what Zomato will have now?
So Nikunj, I still remember when I gave out the name of Paytm, you came on the I think Aisha was interviewing me. You came and you started drilling me on that. But frankly, I mean, what do you look at a platform, right? I mean, you're looking at the fact that it offers convenience. As you rightly said, that smaller towns may not be the convenience story. And that's why you saw that they moved out of some 200 odd towns to 25, if I remember right, the figure. They moved out of those smaller towns as such. And the top 30 still account for a bulk of, majority of their revenues as such. And our feel is that even there's enough potential to go about giving more convenience to the consumers as such. So I think we'll stick to that. And frankly, I mean, it's a trend, maybe not now, but later at some point in time when industrialization hits these smaller towns also, you'll see that convenience will play out to that extent. And frankly, that's the call on India altogether.
What about your outlook on how things have transpired within the Adani group of stocks? Earlier this morning as well, we were talking about it, saying that now perhaps it will be guided by purely news flow. Your take?
So, Aman, frankly, I mean, I don't think Adani ever had a problem of solvency, right? I mean, it was more of a valuation call than anything else. And they were very prudent using their expensively priced stocks or whatever you want to call them as currency to buy businesses, genuine businesses and such. So obviously these are cash flow companies, and I don't think there's a problem here. In fact, we were just looking at the bond payments that are due, and the first bullets are sometime in FY of 25 as such. So they're very well in place there. Frankly, I mean, again, the call here is that you should look at valuations, and we've been very selective in this space. We've we have a couple of Adani companies as such, and they're both in terms of cash flows or PEs or valuations, whatever you want to go, debt equity, you want to play those names, they're very much in sync with what our guidelines give out as such.
Adani Ports and Ambuja stroke ACC.
You guessed it.
Is it a good time, let's say, to buy more into Adani group of stocks, the two names which qualify as per your internal process? Because right now there is a technical factor which is at play. Fundamentally, nothing changes there. Nothing changes for a cement company as long as the demand is real. Nothing changes for a port company as long as India is importing coal and India is exporting machinery and grain. So is it a good time to perhaps add more into, let's say, Ambuja, ACC, stroke Adani Ports?
So, Nikunj, I won't tell you whether it's time to buy or sell or whatever, but let me put it this way. Ports business, right? I mean, they account for roughly around probably a fifth of the port traffic in the country. They account for almost 40% of the container traffic in the country. And the fact is that the group itself, all over, I mean, 1/5 of probably the power that goes in and stuff like that. So it's just a massive play as such, yeah. Ultimately, the investor has to take his own call. Our stance has been that whenever we saw a correction in these names, we did pick up the names as such, and I'll leave it there as such. And frankly, I mean, our comfort level has grown much more in the correction that came by in these two names per se. So.
Okay, and I just wanted to understand as well what the outlook is on auto, because as far as I understand, there's no real exposure within the space, so it's very negligible, then, Shah?
Nothing. In fact, there's zero exposure in the space. We continue to believe that there's a big disruption happening in this space, and one has seen that in the two-wheeler space per se. The way the demand has, not demand, rather the way the growth has been taken away by the EVs. I think it's a matter of time before it happens in the PV space also. And in fact, one has seen a new Chinese player coming in, and he's probably the world's largest EV manufacturer today. In fact, unseating Tesla also to that extent. So I think there's a lot of heat going on in that space, and we would rather avoid getting in there.
It's always great having you on the show. Glad that you could take time out and join in today.
Thank you, Aisha.
Okay, let's just revisit what the market has settled in at, and it seemed like a tempered start with a lot of individual stock prices moving here and there. And flat as flat can be actually on the index. 17,863 is where we're currently at. The big mover this morning is Glenmark after its numbers. Glenmark Pharma holding up 3.5% on the futures. A very strong move coming in the cash markets as well. 4% higher for Glenmark as we speak. India Cement flying high. 202 is where that stock is. Nalco reacting to its numbers. There's Titan, which is holding out. And then Bharat Forge as well, which is looking up by about almost 3% as we speak. Nalco as well reacting to its numbers. Titan going strong and Bharat Forge up nearly 3% as we speak right now. And Nikunj, you were right about IDFC. The futures price is currently lower by 13.5%.
Yeah, it's adjusting to the dividend. I mean, that's what I understand. And now as per the new dividend policy, if you are owning a F&O stock as well, you will get some dividend, dividend advantage. Let's now connect with the management of Thamax. Ashish Bhandari, Managing Director and CEO of Thamax Group, joins us now. Ashish, good morning. Thank you for joining us. Okay, let's look at the numbers here, sir. The strong order flow or the strong order book inflow continues. Margins have improved. So the big picture is perhaps heartening for Thamax for the quarter gone by. But my question is that if the order momentum is strong and if margins are picking up, then why have you reported flat revenue growth if I look at the sequential numbers?
Flat revenue growth or flat orders growth? We have shown fairly decent orders growth. If you take a good 1 year backlog in a sense, the immediate quarter, both Q3 and what you would see in Q4, last year we reported significant single one-time big orders. And this year, actually, until this quarter, we haven't had anything, a single big order to report per se. nothing of the order of 900,000 crores. So the order book that you see is made up of a lot of smaller orders, especially the 10 to 50 crore range of orders. We have had plenty full, and we see the pipeline continuing to be full of such opportunities.
Broadly tell us that as we speak, how much of your order book is the legacy order book which will get executed over next 2 or 3 quarters, and how much of your existing order book is the new high margin order book?
So actually, there isn't that much of a difference between a legacy order book and a new order book. The improved margins that you see are actually just impact of stable commodity prices, which is the environment that we are in. And previously, when commodity prices were going up, we had a bit of an impact on our overall backlog. Also, our chemicals business, which too was impacted by commodity prices and international freight prices. So there is some amount of stability. So it isn't as much of what was old and new. It is just stability in commodity prices, which is giving us a bit of a runway.
So, what's the outlook then on your overall order book as to where you see it headed? Your order booking was about 10% lower at about 2,204 crore rupees. What's the outlook? Because you did talk about a lot of those small size orders. So, in light of that, can we assume then that the order booking trajectory will be a little bit tempered for the year?
I think that, yeah, the order book trajectory will be tempered. And I've been saying that for some time. Yeah, we do not have as many large petrochemical orders as we did in the past. FGD and petrochemical, both of these areas which give us some of our biggest projects, we don't have those in our pipeline. The good part is those two sectors are also some of the toughest sectors to execute from a profitability perspective. What we have now are lot of smaller projects. The backlog is reflective in that sense of what the future will be like as well. We see continued activity in some of these sectors, especially sugar, steel, portions of chemicals, but not as much in FGD and refining. So there's a sector shift. Overall, the number of orders and the quality of orders will continue to be good. We won't have as many big orders, which will reflect in our total order book number for sure.
Right. But tell me, Ashish, what is the domestic versus export order inflow looking like? And does it still stand at that 85-15 kind of ratio?
The international situation is better. I think that 80-20 should move more towards 70-30 long term, given our international subsidiaries are also stable and doing reasonably well right now. Overall, we see good momentum both in India and internationally.
Could you quantify though? What's the international order book like and what's the visibility in the very near term?
See, with our business where one single big order can move numbers here and there. So I would say in general, we're targeting a 70-30, that a 30% international business and a 70% domestic. And I think if I look at a 12-month period, at least our expectation would be, we would be somewhere in that ratio. At least that's our projection.
Ashish, there are 2 or 3 things which markets and investors track with a magnifying glass: order book, margins, and the visibility in terms of where the orders are coming from. Your margins have gone up by about 90 bips if I do a comparison here. But do you think you have enough and more necessary levers in place that if not in this financial year, hopefully somewhere in FY25, your margins could go to 10%? Because if your expertise is increasing, if the complexity of your projects are increasing, what is stopping you from going to 10% margins?
Okay, I think this will be a slightly longer answer, and I'll give my best to answer our question. Yes, see, Thermax is essentially 3 separate companies. We have, in the sense, 3 parts of our business that have got different levers. We have a big projects business, which is negative working capital, very low depreciation, very high return from that perspective. But in that business, the profitability, even if you think of a business that is much, much bigger, will not be anything greater than 5 to 8%. That's the range it will work in. So for you to come and say, look, can you be 10% profitability? That business will never be 10% profitability, but it'll always be very high cash generating of a very low depreciated base. Yeah, so the return on equity will be extremely, extremely high. The second part of our business is our products business. This is where you can come back and say, look, can you be 10% profitability? I definitely think we can be 10% profitability, but this is also a part of the business where with all the new energy moves, we want to be investing. We want to be investing in people. We want to be investing in new engineering capabilities, new products, all of that. So we will be in a period of investment. The third part of our business, where a lot of our cash is going right now, is our solutions business and our green solutions business. This is where we are providing energy as a service. So this is where our solar OpEx business is, our biomass-based services businesses. These are places where we own a plant from anywhere from 10 to 25 years. So in most of these, the initial profitability is low, but the profitability over the life cycle is extremely high. In this business, we target return on equity and equity IRR. We don't look at a single year profitability because these are much, much longer period projects. So you have to look at Thermax as an amalgamation on all three. As an amalgamated business, I don't see 10% as a reasonable expectation. While we have very high growth expectations, the profitability number on an amalgamated business at 10% is probably unlikely.
Ashish, great to have you today on ET Now. Thanks as always for taking the time out. And you can see on the visuals right across the screen, Prime Minister Narendra Modi is currently at Asia's largest aero show, Aero India 2023, currently underway in Bangalore. Remember, this is the 14th edition of the event and will display indigenous equipment and technologies to forge partnerships with foreign companies as well. Nearly 809 companies from 98 countries are expected to have taken part in the event, though the event is largely military dominated. It also features India's efforts to accommodate a domestic travel boom and rebuild its brand abroad as well. The theme of Aero India this time around is the runway to 1 billion opportunities, and there you can see the visuals coming in live. Okay, let's now welcome on board the management of M&M and talk about their fabulous quarter. Rajesh Jejurikar, ED Auto and Farm Sectors at M&M, joins in on the show. Rajesh, hi, good morning. Great to have you on ET Now as always.
Hi, good to be on the show. Thanks for having me.
Rajesh, I guess all highlights were in Hyderabad over the weekend. Give us a quick synopsis of all the fabulous launches that you had.
Well, we missed having you there, so
yes.
but it was a good, long, and exciting weekend ahead that just went by. We showcased two of our Born Electric models there, which we had actually showcased for the first time in Banbury on August 15th last year. One was the BO5 and the XUV E9. So these were, two of the under the two brands. As you know, we're doing a two-brand strategy. We showed one of each. But what really I think got everybody's adrenaline going was the BE Rally version, which in a way took us from race to road to off-road, because the rally version is really a very fabulous looking exploratory vehicle. In a way, we think about that as the electrified Thar equivalent in the electric space. So that I think really got everyone going. And also, positioning our electric as a lifestyle, because we set these reveals around a fashion event. So we called it actually the EV Fashion Festival. So it was a nice event.
Right. I know we missed all the fabulous launches at Hyderabad as well, but maybe next time. Let's now talk about the fabulous quarter that you as well had. And You know, the tractor industry growth, Rajesh, is expected to be over 10%. What kind of growth are you expecting for the full year? Because I recall in our last interaction, 2022 end, you were talking about for the tractor industry demand to actually grow, you will require higher government spend. And it already being the run up to the election year, you don't see as much of it already happening. But what's the visibility that you have going forward?
Yeah, so firstly for this year, which is the F24 year, which will end in March, we've said that the industry would grow upward of 10%. We significantly upped that number from the last interaction when we were saying it will be in the region of 5-6% in that arena. So I think that that we've up to 10%, and that was enabled by the following positive factors. One is we saw terms of trade for farmers improve, and this came out of mandi prices being much higher than MSPs. So, that has led to a very positive sentiment. The second is the crop that's coming out now, unless something goes wrong in March by way of too much heat or off-seasonal rain, is going to be a really good wheat crop. So there's a lot of positivity around that as well. And we have seen improved government spending in the second half of the year. So, these were three very positive enabling factors which have enabled Q3 and make us positive about the Q4 as well, which is why we've upped the industry forecast for this year to 10% plus. We haven't yet put out a number for the year F24. There is, one critical uncertainty around the monsoon. We've had 4 years of normal monsoon, which is unprecedented. So let's see what happens as we go into F24. And, you've rightly raised the question around government spending and how that's going to play out in the year F24.
Morning, Nikunj also joining in.
But just to, I think just to play out.
Yeah, please go ahead.
Sorry, I'll just complete this and then give it back to you. 920,000 plus is a really good size of industry. So the tractor industry is on a really high level of base. We've seen in the last 3 years a CAGR of over 9%. So, on a very good base, we're seeing good growth. So, overall, we feel good about the state of the industry.
My next question is about the EBIT margins of the auto business. Now, you are a clear market leader in the SUV market. It's a niche market. It's a market where margins, technically because you are a niche player in a niche product, are decent. But your margins are nowhere close to 10%. So progressively, because you are in a niche market and your product launches have been so strong, is there a linear structural improvement in margins, which is that with each coming quarter, with each passing year, margins will only head higher in the automobile business?
Yeah, so, firstly, a couple of clarifications, corrections, if I may. SUV is no longer a niche segment. SUVs are now 50% of the passenger vehicle market in India. So, to say that SUVs is niche may have been a thing of the past, but today SUVs is really mainstream. In this mainstream segment, we have a significant presence. So, by way of revenue market share, last 4 quarters, we've been number 1 in an industry which is 50% of the total passenger vehicle market. Even by way of volume market share, last 3 quarters, we are in the top 1 or 2 players. So, we are playing a mainstream volume game, doing more than 30,000 vehicles a month consistently over the last few months. Last year in Q3, at the end of Q3, we had said that we would expect our margins to go up by 3 percentage points, and we've delivered that. That we had said will happen in the medium term. We also have the best margins amongst all published auto results by way of the best OPM, which is way above 10%. The one thing that I just want we always clarify that in an upward commodity cycle, when we take price increases or pass on costs, so there are in an inflationary environment, you're not able to pass on the margin on top of the cost because every player is attempting to make sure they pass on the costs. We've seen a huge inflation in the last 2.5 years, almost 17-18% on commodities, plus the regulation change, starting with the BS6 in 2020, which is just 2.5 years back. coming into the 6.2 right now. So there is an inflationary environment, and in that inflationary environment, percentage margin will always be under pressures. But in spite of that, we've seen an over 3% improvement in the margin, taking us close to 6.8% as a PBIT margin for the auto business.
Okay. The SUV launches have been super duper for Mahindra and Mahindra. Long waiting periods, great acceptance, strong order booking. When will things start improving on the supply front? For shareholders, ultimately what matters is that when will the demand translate into cash flows? When will the demand translate into profitability? Do you see things improving and changing significantly in this calendar year?
Yeah, so firstly, if you look at the traction of data, we moved up from something like 19,000 a month in SUVs to over 30,000 a month. So there has been a significant change in the traction by way of converting demand to supply. And which is why we are seeing such strong growth, and that's why we are number one on SUV revenue market share, and that's why we are number one, number two, even on volume market share, in spite of having the highest average selling price in the industry. So we have seen a significant improvement in the overall delivery. We also put out a plan for the pace at which our capacity increase will happen in SUVs. We were at 19,000 a month, like I said. We now have capacities which have gone up to 39,000 a month. We're not able to fully leverage all of that because of uncertainty and volatility on semiconductors, and we've had some concerns on affecting a couple of our models. And then over the next 12 months, that's going to go up to 49,000 a month. So we've invested in capacity creation as well. On the LCV less than 3.5 tons side as well, we've seen very, very good traction and movement, where we've gained 5 share points, taking us to a level of about over 40%, 44%. So I think in the two key segments we play, we've actually converted demand into volume. The fact that there's more demand coming in, and hence waiting periods have not come down as much as we like, is something that we hope we'll resolve as we go along. But I'm just correcting to say that we've seen very strong absolute increase in volumes as well, and that's translated into very high profits. We have delivered our highest ever profits of 2029 on the auto farm side, which was a growth of 52% over the same quarter last year.
Right. Rajesh, so has the waiting period come down or not?
Yeah, the waiting period has come down, but not enough to make either customers happy or anyone of us happy. But it has come down by a couple of months, some of our models more than others. But there's, like we all know, there's more work to be done in this space. The pace at which we're getting new orders is faster than the pace at which we are able to supply. So we do have a backlog, and new orders is still coming in at a very strong pace.
That's good to know. Good morning, and I wanted to also understand, because as part of the host of SUVs that were launched, there was also the announcement and launch of EVs. So what's next? What's in the works? What's the strategy here?
So right now what we have is the product we just launched, which is the XUV400. That's got off to a very good start. We'll start deliveries of that in March, but we did deliver the first of that, which is a one-of-one vehicle which we had auctioned out, and we delivered that on the 10th of February at this lifestyle event in Hyderabad. That got auctioned at a little over 1 crore of rupees as a one-on-one, and of course that money will go to some of the winners of our sustainability championship as an award, or to a charity of the choice of the auction winner. But that has got off again to a very good start, and we've got over 15,000 bookings in just 13 days of opening bookings.
Since we're talking about EVs,
and
Rajesh.
then of course, sorry, as I mentioned earlier, we have a stream of Born Electrics. Yeah, sorry, go on.
No, please finish your point.
Yeah, we have a stream of Born Electrics. We spoke about some of them, and that will be launch towards the end of 2024 going through 2025.
Okay, one last final question on EVs. I know you've gone on record telling me that the focus will always be ICE engines and that they will have a larger, a pie in the entire segment as opposed to EVs. But considering EVs are all the rage right now, and you are also, coming up with more and more launches, where do you see the EV segment for SUVs particularly going forward? And are there more launches that we can expect after XUV 400?
Yeah, so as we've said in the past, and in my earlier conversation with you as well, in 2027 we would expect 20 to 30% of our portfolio of SUVs to be electric. Of course, that could be higher if regulation comes in, mandating more electric vehicles, but we think that's a very good, healthy pace. So our focus is on driving electrification rapidly. We think 20 to 30% in the next 4 to 5 years is a strong ambition. That would translate to roughly 180,000 to 200,000 electric SUVs a year, which is a good number. We do believe that this segment will be very amenable to moving to electric. And when we are saying that we expect ICE to remain strong, we are saying that 70% in the next 4 to 5 years will still be ICE vehicles, and that's by itself a strong number. So, I think over the next 5 to 7 years, we will be straddling our strategy of having strong electric portfolio while consolidating and building on ICE, and we'll need to have both going in parallel.
Wrap it up with one final point. What has worked like a charm for Mahindra and Mahindra is the fact that SUVs become the mainstay for the automotive business, and it's now incremental 40% sales are coming in the car category from the SUV category. Do you see this as a multi-year trend? Next 5-7 years, do you think this trend is real and it's here to stay?
Yeah, we do believe that SUVs will be mainstay in the Indian market. Sorry? Yeah. So I was saying we do think that SUVs will be mainstay in the Indian market because there are multiple enabling factors. One is, the SUV gives you a position of height, typically, which allows you to feel like you're king of the road, and that's a great feeling many consumers really value. Also, in some cases, Indians do like to have the greater space because we still do have joint families, people visiting often from family or friends who you like to go out, so there's that as well. And then there is this whole thing of let's get away from the city life that we live and get out. In India, as road infrastructure is improving dramatically, and we're seeing multiple projects playing out. The latest was announced just yesterday. Will enable people to get out and do much more intercity driving, for which SUVs will be fantastic. So we actually see this growth in the category as a key factor going into the future. And unlike many other parts of the world, here SUVs are defined in a way that includes crossover platforms as well. So SUVs are cutting across price points.
Pleasure interacting with you. Thank you so much for taking time out and joining in, giving us a view on all those new launches, what's in the pipeline, as well as the strategy for EV. That's the word coming in from the management of M&M. Just a quick check-in as well as to what the stock price is up to. And as we speak, currently quoting at about 13.55. Tell you what, we'll take a very quick break. Don't go anywhere. We've got lots more lined up, including Chartbuster ideas.